Let's discuss how investors analyze prospective equity investments. We described equities as ownership a little earlier, but what exactly do shareholders own? First, they own the earnings that a company generates after paying off all of its expenses. In the Jenny example, this was her discretionary income. Second, shareholders own the sum total of company assets that are not owed to lenders. This is called the net assets. In the Jenny example, this is the fraction of her house that the bank does not own. Earnings are a stream of future cash flows, just like bond repayments are a stream of future cash flows. The big difference is that fixed income repayments are preordained, whereas equity earnings are not. Moreover, changes from year to year in company revenues and costs make residual earnings volatile. We can best illustrate earnings volatility by examining the earnings of a large public company over several decades. Let's take automotive company Ford from 1988 to 2014. Now we bring up its financial statements by selecting the FA function and then selecting its income statement. Income statement runs top to bottom from the top line, accounting lingo for revenues, to the bottom line, accounting lingo for earnings, also known as net income. Let's bring up a chart of Ford's net income. As we can see here, Ford had positive earnings in the late 80s, lost money in the early 90s, made money through the 90s, lost money in two periods in the 2000s, and made money again after the financial crisis. Why are earnings so volatile? To understand that, let's look at the drivers of earnings, which are revenues and costs. First, let's plot Ford's revenues on a chart. Ford's revenue doubled from $90 billion in 1988 to almost $180 billion in 2005 before falling sharply in the financial crisis. Now let's subtract Ford's total costs from revenue. As you can see, costs have also been very variable over the period. When costs are less than revenue, the red bar stops above the x-axis, leaving Ford with positive earnings, such as in 2011. When costs are more than revenue, the red bar dips beneath the x-axis, leaving Ford with a loss, such as in 2008. Now you can see how revenue and cost volatility are together responsible for earnings volatility. Notice how this stream of earnings is far more volatile than fixed income repayments on a bond. Equity investors have their work cut out estimating the future cash flows of companies. While we just looked at Ford's annual revenues, costs, and earnings, companies will typically report these numbers on a quarterly basis, that is, 4 times per year. We can see company earnings reports on the calendar by typing Earnings Calendar into the command line and selecting the EVTS Events function. Quarterly financial numbers are reported to investors at earnings announcements. These are the moments of truth when shareholders learn how well the company is doing. Sound familiar? Earnings announcements have a lot in common with the release of economic indicators. Both have scheduled release dates. Equity earnings tend to be quarterly, while economic indicators tend to be either monthly or quarterly. Both are eagerly awaited and are the subject of speculation and estimation. Both have the capacity to move the market if the numbers surprise. We saw when some major economic indicators are released. When exactly are earnings released? Let's plot a bar chart showing when the Q1, Q2, Q3, and Q4 2013 earnings announcements were made by all members of the S&P 500. The bar height shows the number of earnings announcements per week. The date range begins in April 2013, which is when the first Q1 2013 results were announced. The bar chart ends in March 2014, which is when the final Q4 2013 results were announced. The green bars represent Q1 2013 earnings. The blue bars represent Q2, yellow Q3, and red Q4. Notice how the main slew of earnings comes out within 3 to 5 weeks of the quarter ending. Not a good time for an equity trader, portfolio manager, or analyst to go on vacation. 4 quarters, 4 earnings seasons. Pretty simple. Not so fast. This chart only shows earnings announcements for 371 members of the S&P 500. Why? The other 129 members have financial years that do not align with the calendar year. If we now plot on all the other S&P 500 earnings announcements over that period, we realize that earnings season is more evergreen than deciduous. Perhaps there's never a good time for a finance professional to go on holiday. As shareholders are entitled to the earnings of a company, the core part of company analysis for shareholders is the estimation of future company earnings. To do so, analysts must understand the following: what industry or industries the company is in, who the customers and suppliers are, what the revenue growth prospects are, and how the costs break down. A lot of the revenue and cost analysis is industry dependent. The consistency of revenues and costs differ from one industry to the next. Therefore, the first question to ask when looking at any company is, what industry is it in? This is an easy question to answer if the company in question operates in just one industry. Tiffany, for example, is just a jewelry store. General Electric, on the other hand, makes lots of things, including gas turbines, trains, aircraft engines, and medical scanners. If we type Tiffany into the command line, select Tiffany & Co., then click on the Security Description or DES function. We can see that Tiffany operates jewelry stores. If we now type General Electric into the top left amber field and select General Electric Co., we see that GE is a globally diversified technology and financial services company, which makes aircraft engines, power generators, water processors, medical imaging devices, financial products, and industrial products. Some companies operate across many industries. It is possible to break down a company's revenue by industry. Let's load Tiffany again and pull up the Company Classification Browser, or CCB function. Here we can see that 100% of Tiffany's revenue comes from jewelry stores. If we now switch to GE, we can see that it generates revenue across several industries. Industries are arranged into hierarchies. If we look at the S&P 500, we can see the 11 big industry families. In the case of Tiffany, jewelry stores is part of the consumer discretionary family. Meanwhile, many of GE's industries are part of the industrials family. Note how jewelry stores and aircraft engines are far more granular than consumer discretionary and industrials. The nested hierarchy of industries is similar to the zoological classification system. The 11 big buckets are the equivalent of domains. The most granular industries are the equivalent of species. We can pull up the corporate zoological classification system by typing industry classification into the command line and selecting the ICS function. Let's demonstrate how this works by searching for the phosphate fertilizer industry, which inhabits the materials family. If we drill into materials, chemicals, agricultural chemicals, and fertilizers, we can ultimately find the phosphate fertilizer industry. The table in the bottom right-hand corner lists the companies that compete in the phosphate fertilizer industry. The industry revenue column displays an estimate of the phosphate fertilizer revenue for each company. As of February 2017, we can see that Bloomberg had identified 43 companies that manufacture phosphate fertilizers and estimated that these companies generate $21 billion in revenue from the phosphate fertilizer industry. ICS is a useful market sizing tool. You will now appreciate the kaleidoscopic array of industries in the world. In total, this tree contains over 2,000 distinct industries. When estimating revenues and costs, it is helpful to learn from whom the revenues come and to whom the costs go. By knowing the customers and how well they're doing, an analyst can generate more accurate revenue forecasts. By knowing the suppliers, an analyst can better anticipate potential supplier problems such as bankruptcy, product problems, or currency movements. Let's visualize a company's supply chain. Here in the middle of the screen is a company you are examining, Widget Co. Imagine Widget Co. has 3 separate customers. Subject to disclosure, revenue can be assigned to each. Next, imagine that Widget Co. needs 3 suppliers to build the widgets that it sells. Therefore, costs can be assigned to each. Of course, Widget Co. may not be the only supplier of widgets to its customers. It may have competitors. Every company exists in an ecosystem of customers, suppliers, and competitors. To the company on the right, Widget Co. is a supplier. To the company on the left, Widget Co. is a customer. Let's look at a real example using a large, well-known company, aircraft manufacturer Boeing. We can visualize Boeing's supply chain using the supply chain function, or SPLC. Boeing is in the middle. 211 customers are on the right, 480 suppliers are on the left, and 47 competitors are along the bottom. If we click on the box for Boeing's largest customer, the U.S. government, we can see from Boeing's filings that about a quarter of its revenues come from the American Department of Defense. Therefore, Boeing shareholders should be interested in news on the U.S. defense budget. Let's demonstrate how the supply chain of Boeing fits together. Boeing sells aircraft to Delta Airlines to refresh its fleet. As Delta is a customer of Boeing, that makes Boeing a supplier of Delta. Delta Airlines competes with American Airlines to ferry people around the world. American Airlines buys aircraft from Airbus, making Airbus a supplier of American Airlines. Airbus, by the way, competes with Boeing to sell planes to airlines. Airbus buys engines from Rolls-Royce, which competes with United Technologies in the engine business. United Technologies happens to sell engines to Boeing. Now we can appreciate this web of relationships. Insights into a company's supply chain lead to more accurate estimates. Revenue projections are at the heart of any company's financial model. Industry insights are needed when sizing the market and estimating market shares. Regardless of industry, the two questions are the same. How big is the pie, and how big is the company's slice of that pie? Given rapid changes in the healthcare industry, pharmaceuticals can provide a vivid illustration of these concepts, the growth in a pie and the size of the slice claimed by each company. Let's type Bloomberg Intelligence into the command line, select the BI function, click on Healthcare, then Large Pharma, and finally the Industry tab. Here we can see a table of the global revenue of many families of drugs. Let's focus on treatments for multiple sclerosis, known as MS. If we click on the chart next to MS, we can see the global revenue for the industry, and it grew steeply for most of the duration shown, until recently. What happened? If we open up the MS tab, we see it subdivides into oral treatments, pills, and injectable treatments. By clicking on the oral chart, we can see that pill treatment is new and booming. If we then click on the injectable chart, we can see that it was booming until pill treatment took off. Now it is in decline. No surprise considering people generally prefer tablets to injections. If we then examine the specific oral treatments, we realize that Biogen's tablet has taken the bulk of the market share from injectable treatments. So during this time period, overall MS treatment revenue plateaued, and Biogen's successful product launch took share from other players. As we saw a little earlier with Ford, earnings equals revenues minus costs. Therefore, an analyst needs a handle on the cost base of the company in question. In particular, analysts like to know which costs are fixed, which costs are variable, the cost of labor, and any cost exposure to commodity prices. Using wind power as an example, let's demonstrate how an analyst might break down the cost base of a wind turbine company. Here we can see on the Bloomberg Intelligence Wind Energy Dashboard Cost Analysis tab that the rotor accounts for 25% of the costs, the drivetrain 56%, and the tower 18%. Imagine if the price of blades were rumored to be going up, and an analyst wanted to know how that may affect the wind turbine manufacturer's earnings. Here we can see that the blades account for 15% of the overall cost. Knowing this would enable an analyst to quantify the earnings impact of a price change. Let's demonstrate how an analyst could gain insight using the tools we have discussed. Say you're an analyst and you're trying to understand why Rolls-Royce's revenue rose from £6 billion in 2003 to £14 billion in 2014. First off, what industry is Rolls-Royce in? Luxury vehicles, right? Let's type Rolls-Royce into the command line, select the stock, then pull up the company classification browser. In fact, 67% of Rolls-Royce's revenue comes from aircraft engines, while 10% comes from nuclear submarine propulsion systems. Rolls-Royce powers the entire submarine fleet of the UK's Royal Navy. The car business was sold a long time ago, which is why you don't see automobiles on the revenue breakdown. How big was the pie in its major line of business, aircraft engines? If we go into Bloomberg Intelligence, select industrials, open the Aerospace and Defense dashboard, and look at the engine market, we can see that the engine industry overall was booming. The chart shows that the global aircraft engine industry revenue multiplied tenfold over the given period. Rolls-Royce, in fact, sold 1,600 engines over the time span shown. How big was Rolls-Royce's slice? Here we can see the main players and their relative sizes. General Electric was by far the biggest player, while Rolls-Royce was neck and neck with United Technologies' Pratt & Whitney brand. Who was buying all these GE, Rolls-Royce, and UTC engines? Let's go back in time and look at the customer industry for aircraft engines, aircraft manufacturers. Here we can see that aircraft manufacturing was a duopoly between Boeing and Airbus. Their commercial aircraft revenue soared skyward over that period. Boeing's commercial aircraft revenue tripled. Commercial aircraft revenue at rival Airbus doubled over the same period. What drove Boeing and Airbus's order book so steeply? If we drill into the consistency of the deliveries for Boeing, we can see that one of the major drivers was the new 787 Dreamliner. If we drill into the consistency of the deliveries for Airbus, we can see that one of the major drivers was the A320. The success of this airline model was foundational to the success of Airbus. So the aircraft engine industry boomed because the aircraft industry boomed. But why did the aircraft industry boom? Let's look at what was going on in the ultimate customer industry, airlines. Let's access Bloomberg Intelligence and go to the airline's dashboard. The simplest way to measure airline activity is by the Global Revenue Passenger Kilometer metric. This is the total number of kilometers flown in the year by all paying passengers globally. By this metric, we can see that airline activity has risen by approximately 50% from the start of 2008 to the end of 2014, when adjusting for the normal seasonality in airline travel. There are more than 100,000 commercial flights per day worldwide. Growth is set to continue, with Boeing forecasting that China, which now has half the RPK of the U.S., will overtake the U.S. as the world's largest aviation market. So what have we learned? The aircraft engine industry did well. Why? Because the aircraft manufacturing industry did well, with new models being sold. Why? Because airline travel boomed, spurring demand for new aircraft and engines. Engines sold well because aircraft sold well, because plane tickets sold well. Once an analyst knows the relevant industries, she can then generate financial estimates for the company in question. The first step is to analyze historic performance using the reported financial numbers, otherwise known as the actuals. By modeling historic company performance, the analyst can project the drivers of revenues and costs and use these to estimate earnings. The first thing an analyst does, therefore, when she picks up coverage of a company is to examine previous earnings statements and read the transcripts of recent company investor conference calls. She does this by typing events into the command line, selecting the EVT Company Events database, and checking the earnings call checkbox to bring up the recent conference call transcripts for Delta Airlines. These provide the context to the company's performance, in particular, the management's Q&A with analysts. Determining underlying drivers is both an art and a science. An art because it demands imagination. A science because then the analyst must demonstrate mathematically the causal, intuitive link between the driver and the company's financial results. This simplification process is frequently where the biggest errors occur. It pays to follow two pieces of Albert Einstein's advice. Everything should be made as simple as possible, but no simpler, and not everything that can be counted counts. And not everything that counts can be counted. In plain English, analysts sometimes build elaborate models that miss the point. The world is full of surprising underlying drivers. Pandemics affect the number of air travelers. High Wall Street bonuses boost jewelry sales. Radioactive leaks affect wheat prices for food producers. Booming stock markets lift recreational vehicle sales. The declining prevalence of smoking dents pacemaker sales. The rise of the middle class in emerging markets demands more meat, which in turn demands more fertilizer. In some instances, a company's activities can have multiple drivers. Say you are studying South African miner Impala, which sells the precious metal platinum. What are the main demand drivers for platinum? Auto manufacturers use it to make catalytic converters, 51% of demand. Jewelry manufacturers use it to make wedding rings, 16% of demand. Electronics manufacturers use it to make circuit boards, 9% of demand. Investors use it as a store of value, 6% of demand. It is also used in the chemicals, dental, glass, refining, and medical industries. Analysts need to understand many unrelated use cases to get an accurate grip on platinum demand. We can illustrate how drivers are used to estimate future earnings by looking at Delta Airlines shortly before it released its Q1 2015 earnings. Imagine an analyst was trying to estimate what the results would be. She clicked into the Earnings tab on the airline's dashboard and then selected the Analyzer tab to see the financial model for Delta. She looked at what drove Delta's revenues and costs. Delta's revenues came from the available capacity, known as available seat miles, the bookings of those seats, known as load factor, and the resulting revenue, known as passenger revenue per available seat mile. The bulk of Delta's cost was fuel. How many gallons did it consume, and how much did each gallon cost? Having many years of this data helped her understand how they linked to reported revenues and costs. Once she understood the link between metrics and past company performance, the analyst was ready to make a call on what she thought the company would report for Q1 2015. In addition to the drivers, she would also have taken into account external data points. How well was the economy doing? Was Delta gaining or losing market share to its competitors? How much were tickets selling for? What was the price of oil for the quarter? And what guidance had management provided on company performance? As a final data point, she took note of what her fellow analysts were predicting. Here she saw that the consensus revenue estimate was $9.4 billion, and the consensus earnings estimate was $519 million. Having understood the historic drivers of Delta's performance and having reviewed the consensus opinion, she was well positioned to make her own estimates for Q1 2015. As she was valuing Delta Airlines, she also took a look at the earnings estimates from her fellow analysts for the following few years by typing earnings into the command line and selecting the EM function. The gold numbers were Delta's reported revenue figures for the last several quarters. The first gray bar, $9.4 billion, was the sales estimate for Q1 2015, while the rest of the gray bars were the consensus revenue estimates for future quarters. They were educated guesses of what the orange bars would be. She wondered where these numbers came from. She clicked on the $9.4 billion number and saw that it was the median of the educated guesses of her fellow analysts. Now let's switch gears and focus on what happens the day a company's results are announced. Analysts of a stock race one another to compare the announced numbers with the consensus estimates. The difference between the reported results and the estimates is called the surprise. When the actual results are above the estimates, it is called a beat, and when below, a miss. Whether a company beats or misses tends to be in the headline of an earnings news story. We saw that analyst consensus estimates represent the mind of the market, but analysts are not infallible. Analysts often struggle to spot turning points. This is why companies that successfully turn themselves around may beat estimates for many quarters in a row. And this is why companies that blow up tend to release a string of profit warnings. Let's demonstrate when analysts struggle to spot two turning points in a row for the same company, BlackBerry. BlackBerry was the original inventor of the phone with full QWERTY keyboard. In the mid-2000s, their gizmos became much loved by white-collar professionals because they allowed business people to get email on the go, meaning they could be contacted on vacation. The phones were so addictive that they earned the nickname Crackberry. They took the corporate world by storm. BlackBerry's revenue multiplied. Let's look at the quarterly revenue for BlackBerry from 2006 to 2008. This was when analysts debated whether BlackBerry could make the leap from niche corporate vendor to mass market brand. Here we can see that from the fourth quarter of 2006 to the fourth quarter of 2008, the actual sales of BlackBerry were greater than analyst consensus estimates, meaning that BlackBerry surprised positively for 9 consecutive quarters. Analysts had missed the boat. At its zenith in 2008, BlackBerry had cornered close to half of the world's smartphone market. Apple released the first iPhone model on June 29, 2007. For a couple of years, businesses did not allow iPhones to connect to corporate email. As soon as they did, business people started switching from the BlackBerry to the iPhone. If we look at the market share of BlackBerry in the overall cell phone market, we can see that its market share dropped from 20% in 2009 to nothing a few years later. Now let's look at the revenue surprises each quarter over this period. We see that in later quarters, BlackBerry surprised negatively. Analysts were behind the curve yet again as businesses and consumers switched in droves to the iPhone. Now imagine a world in which a very clever analyst could correctly and consistently predict the quarterly results of a company. By looking at the consensus, he could tell in advance whether the company would surprise positively or negatively. Could he guarantee that he could make his clients money each quarter? Let's find out by analyzing Apple's earnings announcements and resulting share price moves over several quarters using the SURP function. Over the period shown, there have been several positive and negative sales surprises. On the right, there is a column showing the share price change one day after the quarterly results. Green for when the stock went up and red for when the stock went down. On 6 occasions, a positive surprise was met with a rising share price. And on 3 occasions, a negative surprise was met with a falling share price. However, on the remaining 5 occasions, the share price did not move in the direction that the clever analyst would have guessed. Getting it right 9 out of 14 times, while not a guarantee, is pretty good odds. We can visualize this phenomenon with another Bloomberg terminal function. Let's pull up the earnings analysis screen to view stock price movements for each member of the S&P 500 in the wake of its results announcement. The x-axis shows the scale of the earnings surprise. If the data point is to the right of the vertical line, it means that the company surprised positively, and if to the left, negatively. The y-axis shows the share price performance for the day after the results were released. If the data point is above the horizontal line, it means that the shares went up the day after results, and if below, down. When the surprise was positive, more often than not, the shares went up. Hence, there are more diamonds in the top right quadrant than in the bottom right quadrant. When the surprise was negative, more often than not, the shares went down. Hence, there are more diamonds in the bottom left quadrant than in the top left quadrant. But there are diamonds all over the chart. The relationship is not foolproof. Just because an analyst has a high conviction that a company will surprise positively at its results does not mean that the analyst knows for sure how the shares will react after the results are published. There's more to guessing share price movements than accurately estimating earnings. It's called valuation. Think you've grasped these concepts? Answer these questions to check your understanding. To summarize, each industry has its own outlook. Therefore, the first question that an analyst must ask when valuing a company is, what industry or industries does the company operate in? Financial projections require industry market sizing estimates, market share forecasts, and cost breakdowns. Analysts look for causal, intuitive linkages to understand historic company performance, and these drivers are foundational to earnings estimates. Revenues, costs, and earnings are disclosed in company results announcements. The results are then compared to estimates to determine how well a company is doing.